guys, and welcome back to another Money Tip Monday. I'm your host, Lizy Hofer, and I'm a residential loan officer here in the Phoenix area, and I teach practical money tips to help you make smart home purchases. Today on Money Tip, I thought it would be fun to get on YouTube and Facebook and answer some of your questions. It's always an honor for me to get these in my DMs, to see them on the comments, and it really is my passion to make sure that 2020 is your best financial year ever. Now, before I get into all of that fun stuff, I am gonna need you to like, comment, and subscribe to this awesome channel. So our first question comes from Manny, who was introduced to the channel from my really good friend Javier. And his question is about inheriting a property. He and his fiance have never actually purchased a home on their own, but he did inherit a property. And so his question was about whether or not they would qualify as a first-time home buyer. Well, one thing to really note about mortgages is that you would consider a first-time home buyer somebody who never purchased a home, but for mortgages, it's anyone who hasn't purchased a home in the last 3 years. So technically, Manny would not be a first-time home buyer because he owns a property, but his fiance would, and most first-time home buyer programs only need one person in the couple to qualify as a first-time home buyer. So you guys would definitely qualify for all of the first-time home buyer benefits, and so long as she's not on the title of that home. So my next question comes from MH. And again, guys, I just want to say thank you so much for commenting on the channel. But their scenario was that they were hoping to buy last year, and because of some financial issues and some personal issues, they were delayed to maybe the end of this year, maybe the beginning of next year, and they're really discouraged with house prices increasing, and they were wondering if the market was going to stabilize. So here's the hard thing, right? At the moment, supply is just incredibly low and demand is super high, especially in the Phoenix areas where our population is growing at a rapid pace. And so, it's hard to say whether home values will go down or stabilize, but I can tell you that interest rates are historically low, and the payment that you would have today with today's prices and today's interest rates would probably be lower than they were 2 years ago with higher interest rates and lower values. So I hope that helps. Another question I got was from Thea Davis, who was asking me what a donor gift fund statement is. And so essentially this is a document that we lenders provide to our clients whenever they're going to be receiving a gift from a donor. And basically it just asks them to state their relationship with the borrower, what account the funds are coming from, what amount they're giving, and it verifies that this is not to be repaid. So in lending, right, we don't want to see that you're borrowing for your down payment unless it's secured to an asset like a vehicle or a house. So this donor statement is super important because it's the only affidavit that we have verifying that there is no repayment required. The next question I got was from Trigger Happy 134. And they said, "So Lizy, I have a question for you. I'm looking at buying a home in summertime. What I was trying to originally look for was a 4-bedroom, 2-bath home, originally to be done by myself. And now I'm looking to purchase a home with my father. Any thoughts or advice, because now I might need a 5-bedroom house with 3 bathrooms." So this happens a lot, and it's a really great thing to purchase with someone else because it definitely maximizes your purchasing potential. A couple things that you'll need to note though is that you both will have to do simultaneous applications, and both of you will have to provide financial documents. And my best suggestion is that you guys talk about an exit strategy, because it's an awesome idea to purchase a property together, but there also can be not so awesome consequences when you guys decide to not own that property together. So my best advice is meeting with a financial advisor or a mortgage loan officer who can walk you through all of the different steps. And then you guys definitely need to have some sort of agreement on property ownership, what happens if something were to happen medically to one of you guys, God forbid any of you pass away, but things that you need to think about when you're purchasing with someone else. But guys, it's an awesome way to house hack, an awesome way to expand your purchase price, and in a market where things are so competitive, pulling together your funds and income is a really great idea if you're trying to enter into the housing market. My next question comes from Ka Young, and I apologize if I butchered that. Their question was about what things you need to know when buying a vehicle. And I wanted to record a money tip on this, and I actually am going to because I just went through the experience of buying a car. Here's what I will say. I will say it is so important to do all of your research up front. And in negotiations, it's very important to say, this is what I have found. What will you do for me? And then nothing else. People end up not getting as good of deals just because they don't understand the art of negotiation. The first person to speak always loses, and people are always super uncomfortable being face to face with their salesperson. So doing a bunch of research, emailing in, asking for the best prices available so that people, one, know that you're an educated consumer, two, they know what you're expecting to pay, and three, you're saying, hey, without saying, give me your best price, right? So honestly, it's a phenomenal way of buying a car. It's what I personally did, and you can bet you'll see a money tip about this in the future. So my next question is from Jessica from Phoenix, and she asked, what's the difference between a cash out refinance and a home equity line of credit? Well, the difference between those two is that a cash out refinance is rolled into a first mortgage that's secured by your property, and a line of credit is a second mortgage that actually follows the first mortgage, and it's a flexible, adjustable interest rate. But the cool thing is that you can pay it down and charge it up as you need. Now, some of the benefits of doing a line of credit are, that flexibility with charging and paying off. Some of the not so great advantages is that it's adjustable, and when the market goes up, that interest rate goes up. So a couple things you want to know in this environment specifically, right, is that because interest rates are so low, I'm definitely going to say that doing a cash out refinance makes way more sense than getting a line of credit. It's not typically like that. Oftentimes I recommend people get a home equity line of credit because their first mortgage interest is so low, and doing the cash out would actually increase it. So right now it does make sense to do a cash out versus a HELOC, but you definitely want to time the market on that one. So the final question I'm going to answer, guys, is from Mitchell Makeup, and they're asked, how do you budget when you're self-employed? So one thing, I am not self-employed, but I am an independent salesperson, which means that I'm 100% commission, and I pay for all of my own expenses like employees and marketing and you name it, right? So because this can get a little bit tricky, my best recommendation is to go and look through all of your expenses over the last 2 years and come up with a budget, right, that makes sense, that you can average out for the year, because there are going to be certain months that you pay for more things than other months, and there's going to be certain months where you have larger income than other months. So a couple of people do this a variety of ways. So I just like to do a set percentage every single paycheck, right? So I do a set percentage of each paycheck goes into my business account, but I've seen other people just do an exact amount, right? So depending on what your expenses are, right, if you have a bank account that just continuously gets this money, it's easier than if you just waited till the debt was due and then tried to pay it with your personal account. What I find oftentimes is that because people don't pay their business accounts first, or they don't pay their savings account first, they tend to spend all of the money, and then there isn't enough money left over when those things come due. So look over your finances for the last 2 years, do an average budget, and then budget a percentage or a set amount every single month and put it into an account that is not attached to your personal account before you pay for anything else. That's gonna wrap it up for us, guys. I really appreciate you guys sending in your questions, sending in your DMs. I love to answer you back. But thank you guys so much. Definitely keep posting, definitely keep sending them, and I will see you on another Money Tip Monday.